If you go online right now and search California housing market 2026, half the headlines will tell you it's crashing. The other half will tell you it's recovering.
New data shows that California has added nearly 700,000 new homes over the past 6 years, but the number of residents has grown only 39,000. Supply doesn't seem to be the problem. Why is California still suffering from the housing crisis?
677,000 homes over the past 6 or 7 years. That's about 100,000 homes a year. You realistically would need to have to triple that to 300,000 to 400,000 homes a year to even start to move the needle and make a dent in the 3 to 4 million homes that are needed.
And somehow they're both right. Because California isn't one housing market. It never was. It's dozens of overlapping markets, each moving in different directions at different speeds for completely different reasons. The Bay Area median is hovering around $1.25 million, while the Central Valley starts at $480,000. San Mateo County requires an income over $500,000 to buy the median home, while Sacramento and Fresno have affordability rates near 30%.
I looked at the numbers last night and everyone thought this year was going to be more sales. And right now we're actually trending less sales. SoCal
posted year-over-year price declines. LA down 1.2%, San Diego down 2.6%, Inland Empire down 2.5%, while inland markets are holding steady or rising modestly. So which narrative is true, crash or recovery? The answer is it depends entirely on where in California you're looking, what price segment you're in, and whether you're near a wildfire zone. Today, we're cutting through the noise. We're breaking down the 5 distinct Californias that exist right now inside one state. Because if you try to treat this as a single market, you're going to make a very expensive mistake.
This morning, experts say 2026 could open the door to more affordable housing options. Lawrence Yoon with the National Association of Realtors says more inventory means less competition for homebuyers.
The California we cover in Section 3, the one being reshaped by the insurance crisis, is the one that nobody is pricing correctly yet. Stay for it. If you own, buy, or invest in California real estate, subscribe and hit the bell. We break down regional data every single week because statewide averages will mislead you in this market. Let's get into it. First, the statewide numbers, because they set the stage. In March 2026, California existing single-family home sales totaled around 265,320 units on a seasonally adjusted basis, slightly down from the year before. Fewer homes changing hands. The statewide median price fell to $850,680 in December, a 10-month low and down year over year for the second time in 3 months, the largest annual decline since June 2023. CAR projects existing single-family sales at 274,400 units in 2026, a modest 2% increase over 2025. The Housing Affordability Index improved to 18%, the first real improvement in years. But that still means 82% of California households can't afford the median home. Better isn't the same as good. And here's the lock-in effect that defines everything. Roughly 80% of California homeowners hold mortgages at rates below 5%. Selling means trading that 3% rate for a 6.25% rate, adding hundreds per month and compounding to over $180,000 over a 30-year loan. Most owners are choosing to stay put. That keeps supply artificially tight and prices elevated, even while demand is weak. That's the state. Now the 5 Californias. California number 1, the Bay Area, stabilizing at the stratosphere. Bay Area medians hover around $1.25 million. Affordability sits at roughly 23%. Better than San Diego at 15% or Orange County at 9%. San Mateo County is the outlier.
Buyers and sellers know this well. The Bay Area real estate market is hot, and if you don't act quick, you might miss out. But could a change be on the horizon?
It is certainly still a seller's market. There's absolutely no question about that. Homes continue to sell for record prices across the Bay Area. But some real estate experts say they're beginning to notice signs that the market is starting to level off.
Buying the median home there requires an annual income exceeding $500,000. But the Bay Area is stabilizing, not crashing. Tech sector recovery and rising stock valuations are beginning to revive luxury demand, particularly in Marin and Santa Clara. AI hiring is providing a new demand floor. Silicon Valley is seeing steadier hiring patterns after the layoff adjustments of 2023 to 2024.
6 months ago, I would have expected 100 people through here.
There's no denying the Bay Area real estate market is hot. But the pace is not quite where it was a few months ago, or really near where it was a year ago.
I think it was unsustainable the way it was.
Though sales prices and competition are still high, according to the latest RE/MAX National Housing Report, Bay Area home sales are actually down 17.2% over the last year.
The Bay Area's problem isn't price collapse. It's that prices are so extreme they've created their own economic ecosystem that's almost entirely detached from the rest of the state. If you're a buyer here, the math hasn't changed. It's still brutally expensive. But if you're a seller, the floor is holding. Limited supply, high earners, tech wealth, and international demand continue to support these prices. The Bay Area is not Florida. California number 2, Southern California, the quiet correction. This is where the most visible softening is happening. LA dropped 1.2% year over year. San Diego fell 2.6%. Inland Empire declined 2.5%. California's median price overall fell 2.2% in Q4 2025, the second straight quarter of declines. But here's the nuance. Most analysts expect a stabilization in 2026, with modest 1 to 2% increases as rates ease from 6.6% towards 6.0%. Late 2025 and early 2026 could be the lowest price point of this current cycle. SoCal's correction is real, but it's measured, not a free fall. The 3 million unit housing shortage keeps a floor under prices that markets like Austin and Cape Coral simply don't have.
The market is really strong and robust right now. We have a really strong buying and selling market.
One thing Lauren can't account for, market uncertainty.
Of course, we're always watching the news and seeing how it might affect our market.
The current cause of that uncertainty, the ongoing war with Iran.
Would be the one thing that really dramatically affects our market is if rates continue to be really volatile.
The conflict has unended the housing market across the country. The day before the war, the average rate on a 30-year fixed mortgage home were the lowest in the past 3 years at 5.99%.
The critical split is coastal versus inland. Coastal communities maintain stability from limited supply and lifestyle premium. Inland areas are more volatile, with entry-level segments softer. If you're buying in SoCal right now, the play is to negotiate on inland and entry-level properties where sellers are more flexible, and understand that premium coastal will hold. Folks, if this kind of regional breakdown is helping you see past the headlines, share this video with someone making a real estate decision in California. And if you're not subscribed, hit the bell now. California number 3, the wildfire insurance crisis. The market, nobody is pricing correctly. This is the California that should concern you most, because it cuts across all the other Californias and fundamentally changes the math. Major carriers have pulled out of fire-prone California counties. Replacement coverage through the state's FAIR plan often runs $200 to $500 more per month than a traditional policy.
Right now, California is seeking millions of dollars in penalties from State Farm, saying the insurance company committed hundreds of violations connected to the 2025 Los Angeles wildfires.
California's insurance department says they found about 400 violations, with State Farm allegedly underpaying policyholders and also being slow to investigate claims. In a statement, State Farm rejected any suggestions that it mishandled or intentionally underpaid wildfire claims, calling the state's insurance market, quote, dysfunctional.
50% of properties in some communities are at risk of wildfire over the next 30 years. And the January 2025 Los Angeles wildfires, which devastated Pacific Palisades and Altadena, accelerated the crisis. 1 year later, investors are snapping up burned lots while displaced families still can't find replacement housing. Here's why this matters for pricing. When insurance becomes unavailable or unaffordable, it doesn't just raise the cost of ownership. It removes buyers from the pool entirely. You cannot get a conventional mortgage without homeowners insurance. If your neighborhood is in a fire zone and the only option is fair plan coverage at $500 a month, that's $6,000 a year on top of your mortgage, taxes, and maintenance. Many buyers simply walk away. The insurance crisis is California's version of what Florida is experiencing with its condo laws. The carrying costs are being repriced upward permanently, and the market hasn't fully absorbed that repricing yet. Homes in fire-prone areas are still being listed at prices that assume normal insurance availability. When buyers discover the actual insurance cost during due diligence, deals fall apart. That gap between listed price and insurable price is where the real correction is hiding. California number 4, the Central Valley and Inland Empire, the affordability migration. The Central Valley starts around $480,000 for a median home. The Inland Empire averages around $574,669. These are the markets catching buyers who've been priced out of coastal California. And they're expected to see the strongest demand recovery as mortgage rates ease towards 6%. Stockton Lodi shows a typical value of $519,829 with a modest 0.5% forecast.
The real estate market is shifting in the buyer's favor.
To the first-time buyers, be very encouraged. This is a year for you.
Interest rates slowly fell in the second half of 2025 to an average of 6.2%, and financial expert Brian Ullman expects that trend to continue.
With some actions that the administration is taking to try and push mortgages a little bit lower, we're seeing 30-year mortgages finally drop below 6%. We haven't been here since February of 2023.
Sacramento Roseville sits at $566,303 with a flat 0.2% forecast. These aren't boom markets. They're steady, accessible, and attracting buyers who simply cannot make coastal math work. But there's a catch. California's housing cost burden remains the highest in the nation. Roughly 20% of households spend more than half their income on housing. Even in affordable inland cities, the trade-offs with commute costs, utilities, and summer electricity bills that can exceed coastal usage by 30% are real. Affordable in California is relative. The Central Valley is cheap compared to San Francisco. Compared to the rest of America, it's still a stretch. But Stockton is also projected to decline 4.1% in 2026, the steepest drop in the state. Stockton has crashed before, hardest hit in 2008, volatile ever since. If you're buying inland for affordability, choose carefully. Sacramento and Fresno have more economic diversification. Stockton and some outer Inland Empire communities are higher risk. California number 5, the luxury market, a different planet. Premium coastal properties, Carlsbad, Malibu, Montecito, Palo Alto, operate on entirely different fundamentals. International buyers drove $10.4 billion in California residential purchases, up 46% year over year, with 60% paying all cash. In Palm Beach County, 88% of transactions over $1 million are cash.
Number 1, lifestyle. People are living different than they used to. They have less roommates. They have less people living with them. They work from home. That's number 1. Number 2, you have a $800,000 median price average in California. That's not going down. That's only going to continue to go up. And it's really only a matter of time before we see $900,000. That's an affordability issue, which we're going to continue to deal with. And the last thing is the rates. You look at about 70% of homeowners have rates around 3%. They're not selling. Why would you sell? You have to go spend 3 times as much to get the same house or 1/3 of the house you used to have.
These buyers don't care about mortgage rates. They care about portfolio diversification, climate, lifestyle, and safe haven real estate. Tech wealth from AI is beginning to recirculate into luxury Bay Area real estate. Turnkey, correctly priced luxury homes in top school zones in communities like Carlsbad can go under contract in 10 to 14 days. The luxury market isn't correcting, it's rotating. Capital is shifting from pandemic-era Sunbelt investments back into California's coastal premium. So there it is. 5 Californias, all coexisting inside the same state. The Bay Area, stabilizing at extreme prices, supported by tech and AI. SoCal, quietly correcting 1 to 3%, likely bottoming now. The fire zones being structurally repriced by an insurance crisis that most buyers haven't fully accounted for. The inland markets absorbing coastal refugees but facing their own volatility. And the luxury tier operating on international cash that ignores everything happening below it. Here's what to do. If you're a buyer, stop looking at statewide data. It'll mislead you. Drill into your specific city, your specific zip code, your specific price segment. A $480,000 home in Fresno and a $1.25 million home in San Mateo are not in the same market. They just happen to be in the same state. And before you make an offer anywhere, get insurance quotes first. The insurance math is now as important as the mortgage math. If you're a seller in a declining SoCal or inland market priced to today, not the peak, the statewide median dropped to a 10-month low in December. Sellers who price correctly are still closing. Sellers who price to 2022 are sitting and chasing. If you're a homeowner in a fire-prone area, understand that the insurance crisis isn't temporary. Carriers aren't coming back at pre-2020 rates. Your long-term carrying costs have permanently increased, and that will be reflected in your home's value over time. California's housing market isn't crashing, it isn't booming, it's fragmenting into micro markets that require microanalysis. The days of California real estate always goes up are over. The days of California is crashing are also wrong. The truth is messier, more regional, and more important to understand correctly. Subscribe, hit the bell, and drop a comment telling us which part of California you're watching and which of the 5 Californias you fall into. See you in the next one.